On live. What's going on, Jazmine? How are you?
Hey Ryan, hey Ryan, I'm good. How are you today?
I'm doing awesome. Great catching up with you. I know we were just talking for a couple minutes, and I'm glad we're diving into this because we got a lot of cool stuff to talk about, but this is our first one together, so I'm pretty excited about that. I know that we're trying to kick off the next year by taking action right now and kind of building that momentum so that when we go into the new year, we're already ready to go and have a little momentum going with us. So everything been good?
Everything's great. Thanks so much for making time for me and my people today. I appreciate it.
Absolutely. And for everybody that's watching this, one of the most important things that we want you guys to realize is these are for you so that when you see this, if you listen to this, if you hear something in this short conversation, if you have questions, ask us the questions. We are here. We're doing this for you to ask questions. We're doing this for you to feel comfortable because we know that there's many people out there. They don't know where to start. They don't know where to go. They don't know what to do. And all you have to do is give Jazmine a call, give me a call, or send us a message. Don't feel stupid. Don't feel intimidated. Don't feel anxious. We're going to take all that away for you so that you can realize the home buying process doesn't have to be that complicated, and it definitely doesn't have to be that stressful. So I wanted to just start real quickly with you, Jazmine. You had a question for me, and it had something to do with the approval process and getting pre-approved. What exactly was your question that you wanted me to dive into here first?
So my question was, how easy is it to actually get approved for a mortgage?
Okay, so we say there's really four pillars to getting approved for a mortgage. The first is credit. Credit is your entry point into the game. You can make $100,000 a year. If you don't have a solid credit score, you're not going to get approved for a mortgage because the banks and the lenders, they look at you as being not responsible. So credit is the first most important thing, and credit is not that complicated. It seems complicated if you don't understand it, but if you do just a little research and you start to understand the factors, you'll realize that managing a good credit score, building a good credit score is not complicated at all. But credit is the first most important thing. The next thing we have is what we would call assets, otherwise known as cash, or your money for your down payment and your closing costs. When you buy a house, you have to have enough money for your down payment, which if you go FHA is going to be 3.5%. If you go conventional, it can be anywhere between 3% to 5% or up to 20%. You can actually put whatever you want down, but the down payment money has to come from an account that we can show to be seasoned, which means that money's been in an account for at least 60 days. So it's really important. You want to save up your money so that you can afford the down payment and closing costs. We do have some loan programs that are called down payment assistance programs. Some people will call them first-time homebuyer programs, but that's a program that if you qualify based on income and on credit, we may be able to give you 5% towards your down payment and closing costs. And even if not, we also have something that's called lender credits. Lender credits is basically where your rate can fluctuate. The lower the interest rate, maybe the higher the closing costs. The higher the interest rate, the lower the closing costs. It's kind of like this seesaw. And that's something, if somebody's a little light on closing costs, we can sometimes give a slightly higher rate so that they can afford the house and have a little less down payment money or closing cost money needed to actually close. So credit, then you have assets. Next, we have income. Obviously, the amount of income that you make determines how much house you get to buy. The higher the income, typically, the more expensive of a house you get to buy. The problem is the fourth pillar being expenses, credit, assets, income, expenses. They're the four pillars. Your expenses are going to offset the income. Okay, so to answer how easy is it, it can be very simple. If you have at least a 580 to 620 credit score, you've got a couple $1,000s saved up to buy your house, and your debt to income ratio is pretty good, meaning your debts aren't maximizing and basically using up all of your income, we can help you get approved in about an hour. So not sure if that answers the question in its entirety, but you could literally be approved in about an hour. We may need to verify some income and some assets. As you know, we like to verify the pay stubs. We like to verify your W-2s and make sure that you actually have bank statements that show the money's in an account. That may take another 24 hours or so. But if you have all that stuff together within an hour or two, we can already have a pre-approval ready for you.
And then a pre-approval means what?
A pre-approval is different from a pre-qualification. From a pre-approval standpoint, what that means is this. One, we've run your credit, so we know that your credit is qualifying. If you have too many disputes, you may not qualify. If you have too many negative items, And unfortunately, we may have to do some things where we have to reassess the debt to income ratio because you have a certain amount of collections. That's something that could cause you not to qualify. But if you actually have a pre-approval, we typically won't give you a pre-approval with a, let's say, $250,000 on it. We're going to give you a pre-approval that says you're qualified for up to a $1,500 a month payment or a $1,700 a month payment because of the taxes. You may be looking in the city of Philadelphia, and $250,000 house may only have $2,500 in taxes. But if you look at a $250,000 house in the counties, that house may have $5,000 or $6,000 a year worth of taxes. So that $250,000 number may not work. But basically, if you're pre-approved, you can qualify to buy a house within certain parameters, which means you can actually go out and start showing them houses because they do qualify for that house. Again, a pre-qual, you may get a pre-qual, which would be third-party data. And they're basically just saying, based on the third-party data that we have on you, you should be able to buy a house, but that's not always guaranteed. Pre-approvals mean we have a stamp of approval, meaning you're good to go.
Can I ask one more question?
Sure.
So once you get your pre-approval, what's something that might actually stop the process from actually going? So, sometimes you'll hear people say, oh, I wasn't able to get into the house after all. What's some of those things that can actually stop the process?
The number one thing that would stop the process is there's a couple things that happen when you get approved. And once you're under contract, these things happen. First off, the lender is going to request a title search. They're going to do some research on the property itself, as well as to make sure there's nothing in your name where there's any judgments, tax liens, or anything else that might populate that is on third-party data and not a part of your credit score. We've actually had people where they have judgments against them, or they have liens that didn't show up, or maybe they had charged off student loans. That's not going to show up. It's going to show up on a Cavers report, or maybe even a LexisNexis or an Innovis report. It's not going to show up with TransUnion, Equifax, and Experian. So a lot of times that's one of the things that will happen. Unfortunately, we also sometimes have borrowers that falsify documents and information. They may furnish a pay stub that looks legit, but we call to do a verification of employment, and they say, hey, that person no longer works here. Or that person's quitting and they're no longer working as of the 1st of next month. Those are typically the things that would happen. Most of the time, I would say probably 99% of the time, we do a thorough enough job and ask a thorough enough amount of questions that once we give you an approval, we would know if something's going to populate. Okay. So they're probably really the only reasons, unless it's something completely outside of anything we could foresee. There aren't really that many things that will cause somebody who is pre-approved to not close on the house they go under contract with.
Okay. Thanks, Ryan.
Is that cool? Does that answer those questions for you?
It did.
What I want most of your followers and listeners to realize is this: it is not that complicated. Okay. What we do, and this is something that's why we love working with you as well, is if you look at the whole process, over here's where you start and over here's where you close. Most people, they look at this and they think, oh my gosh, that's a real tall, staircase, and I'm nervous. If you literally just break it down step by step by step by step, it's a lot easier. It's a much easier process. In the beginning, we go through a soft fact finder, and we do this. We don't even pull your credit at first. We want to make sure you qualify before we pull your credit. Okay. Now that means you have to tell us the truth, tell us what's actually happening. Some people, they forget to tell us that they have child support. Some people forget to tell us that, maybe they have an additional loan or something that's not showing on their credit report or that they forgot about. So those little things do matter. But once we go through that soft fact finder and we feel comfortable thinking you'll qualify and you actually like us, which we know you'll love us, then we go forward and pull your credit. Once we pull your credit, we're going to review your credit. If there's things we think you could do to help you, that's great. But if you qualify, you're good to go. That's when we move right on to verifying the income, meaning we're going to get pay stubs. We're going to get W-2s. If you're a 1099 contractor, we're going to need your last 2 years of tax returns, which, by the way, if you're a 1099 contractor, we do have certain loan programs with a qualifying credit score that you only need 1 year of tax returns. We may need a profit and loss letter from your accountant, but there are times and situations where we can get you approved with only 1 year. Or even if it's a bank statement loan, let's just say you're new in business, but you have 12 months of income and bank statements that we can use. We take the 12 months, take all that income, divide it by 12, and that becomes your income average. So that's some of the stuff that we can do. Then the next thing we do is once we have all that stuff done, we run you through a desktop underwriting software, which is what the lenders use. All this stuff can happen in 24 hours. Very simple, just like that. And then they're approved. So that way, as a buyer that you're not wasting your time. And then also Jazmine, the realtor, she knows that you're qualified to be looking at these properties, because the last thing that Jazmine wants to do is show you a house that you fall in love with, but you don't qualify to buy it. Has that ever happened to you actually?
No, because I will not take anyone out without a pre-approval letter.
But
So no,
that's
that has never happened to me.
that's good and that's smart. I mean, we do have a lot of times we'll have buyers come to us and say, my mortgage person told me I was approved for X. I went and started looking at those properties, and what they didn't tell me was that the taxes were higher than what I initially had factored, so I don't qualify. And so therefore they find their home of their dreams. We've actually had people who they had their kids, looking at the house, and everybody's dreams were basically blown up. And then as soon as they found out they didn't qualify, it was like popping a hole in that balloon, and all of a sudden it just fizzled away. So that's one of the things that we specialize in, is making sure that we ask enough questions, we do our due diligence. And when you look at a property, we feel 100% confident that you're not going to be anxious, that it's not going to be stressful, and that you will get approved and qualify, to go to closing on that house.
I like
So
it.
cool. Awesome. I have a question for you. One of the things that we're seeing a lot, we have seen a lot in the past, is people were making crazy offers on houses. Like for a while we saw where people were buying houses and they were going 20, 30, $50,000 over asking price. Are you still seeing that in the market? And if so, are there any circumstances and or reasons behind that?
I would say yes and no. So I think the market is starting to level off a little bit.
Okay.
And you'll actually start to see decreases in prices, because depending on the neighborhood you're looking in, houses are sitting a little bit longer than what they were during COVID times.
Okay.
But what I will say is that I am still seeing that trend if it's a market where there's not a lot of inventory. So for example, I know I have a client who's looking in Springfield and Ridley Park. There's basically nothing in that inventory. So when things do hit the market, they're going a lot of times for 20, 25 above asking price, and there's tons of bidding wars. So I think that it also depends on the neighborhood. So it's still there a little bit, but not as much as we've seen in the last year.
Okay. Okay. You were also mentioning there was a development or something that you found was really successful, and you said people were really bidding that. What was the reason for that property?
So the reason for that one was really more so because the property taxes are so low. So it's called Toby Farms. It's in Brookhaven.
Okay.
And the average home is probably going for about maybe 220 for something that's completely turnkey, a complete flip. They typically have 3 bedrooms, 2 baths, a garage, or off-street parking, and still a backyard, and most likely probably a deck as well. But the selling feature for that neighborhood is not the school district, because the school district is definitely lacking. It's that you get a lot of home for your value, and the property taxes on it is about $2,300 a year. So for Delaware County, that's unheard of.
Oh.
For example, you could go to Ridley. I know for about 6,000, somewhere between 56 and 6,000 and up. Springfield's taxes are about 7,000. Upper Darby is about 5,600 or 4,600, somewhere in that range. So to have taxes at 2,600 in the county and still be safe and still feel good about where you're raising your family is virtually unheard of. So that's what's driving those prices. Actually, I had a client, we put in an offer 15,000 above, and we got outbid.
Did you really?
So we got outbid.
I mean, I think that's to your point. It's amazing. I mean, that's so correct. It's that anytime you can get a house in the counties with taxes under $3,000, that's amazing, because what people don't realize are if you get a mortgage, let's just say you're buying a $250,000 house, you pay a $250,000 house over 360 payments. When you have $5,000 in taxes, or let's just say $6,000 in taxes, that's over 12 months. That's $500 a month just for your taxes. So if you could reduce that by half and only pay $250, that does a lot for your buying power. So I think that that's a great point that, obviously you can drive home to all your borrowers or buyers, is that finding a place that has lower taxes could really be a big difference. Obviously, if you have kids, I think, like you said, the school district is important, but that's huge. I mean, less than $3,000 in taxes. I wish my taxes were less than $3,000.
Most people do.
But so you're saying also that you're still seeing it's still relatively competitive when people are going and making offers on houses. Is that correct?
Definitely, because the inventory, depending on where you're shopping for, the inventory is still really, really low. So it definitely is a seller's market, meaning the sellers kind of have a little bit of the upper hand right now because as soon as the houses hit the market, everyone's pouncing on them.
Yep.
So that is kind of creating a little bit of a buyer frenzy, but not as much as what we saw last year this time.
Okay. So I think one of that does is that leads me to another point, which is really important, is that if you're looking to buy a house, being pre-approved and actually being approved is really important, because if, let's say, you find a house on a Wednesday and they're trying to do an open house on a Saturday or a Sunday, being able to make an offer on Wednesday night, not having to worry about the pre-approval process, being able to just pull that trigger as soon as you find a house that you love and want, that might be able to save you from getting into a bidding war if the house and or the property goes into, an open house situation where multiple people come through it. I feel like I mean, has that been a situation that you've ever faced where people they're not qualified, they're not ready, they just started kicking tires and realized that they missed the opportunity because they didn't have that pre-approval already done?
I've noticed not so much the pre-approval, but more so because they were afraid to actually buy their house.
Really?
So they, like, because a lot of times, well, for me personally, I deal with a lot of first-time home buyers, right? And I love my first-time home buyers.
Sure.
But one thing that I've noticed is sometimes they're afraid to actually pull the trigger. Like everything will say, this is my house, but there's always that, but what if I find something else tomorrow? And then tomorrow comes, and then the day after comes, and the day after comes, and they still haven't found it. And then they're like, you know what? That had to be my house. And one of two things have happened. Either the first thing is it's no longer on the market because it's now under contract, or B, the price has gone up. And I know it's somebody who says yesterday's prices is not today's prices. And that's what they're experiencing, is either the price is going up, the interest rates have creeped up a little bit, or
Mhm.
even the house is no longer available. So those are things that I've seen more so than them not being buyer ready.
I think you bring up a great point, and we just did a video on this actually in the office here, and I actually still have my notes on it. We had a house where somebody was in the market for a $300,000 house, and the monthly payment, now just principal and interest, this did not include the taxes and the insurance, but on a $300,000 house, the initial interest rate when they were initially looking, and they've been looking for a couple months, was 2.5%. That's what we initially priced it at. That payment came out to a late 1185, $1,185. Now interest rates creeping up to 3.25, maybe 3.5, depending on the loan scenario and situation. That same
Mhm.
situation, that rate would be 3.5%, and that makes your payment 1,347. That's $162 difference in just 2 months of time, purely because the interest rates went up. Now, for some people that are buying at the max point of their budget, if the payment goes up $162, they may no longer qualify. And that's one of the things that we're trying to help educate people on, and saying, if that trend is true, where we've already hit the bottom of the interest level market, and over the next couple months, it's going to slowly creep up. I mean, 2.5% and 3% interest rates is not normal. That's not a common thing in the industry. If they go back up to 4.5% where they were just a year ago or 2 years ago, a lot of people are no longer, maybe they'll still qualify, but the houses that they were looking at, they're no longer going to be able to afford to buy, because the interest rates kind of put it blows up their debt to income ratio. So that's interesting. Anything else, any other trends that you're seeing, anything else that you think is really important that you want to bring up on this one?
I think that's about it. Is there anything in particular you want me to speak to?
No, I think we covered enough. I like to keep these relatively short. I think, as people are watching this, as they develop new questions, please, I'm going to tell you, ask the questions, give us good content. Jazmine and I don't want to talk just to talk for the sake of hearing ourselves speak and be on camera. What we want to do is talk about things that we know that you find interesting, or things that you're going to find to be helpful. So if there's anything we've discussed in this video that you feel we should elaborate more on, or if there's a topic that we didn't cover, please send us a message, pick up the phone, make some comments in the post, whatever it is. Let us know what it is that we can discuss that will help give value to you, so that, again, we're not just up here talking, wasting our time, putting information that nobody has an interest in. So if you don't have anything else, I want to just say thanks for your time. It was an awesome conversation. Definitely looking forward to doing this again. And yeah, this was awesome.
Thank you again, Ryan. I can't wait to see what people have to say about it, and more importantly, what is it that they want us to talk about next. But thank you again. I know that your day is busy from sunrise to sunset. So thank you again for making time for this conversation.
You're very welcome. And if you ever want to do a first-time homebuyer seminar, if you work a lot with first-time homebuyers, you can let me know. And obviously people watching this, if you would, have an interest in a first-time buying seminar, or even if it's particular topics like how to create a budget, how to build credit, whatever those things are, let us know. And maybe we'll do our next video on that.
Perfect.
Cool. Awesome. Jazmine, thanks so much. Have yourself an awesome day.
Thank you again. Have an amazing day, Ryan.
You got it, Jazmine. Take care.